Welcome back to Mind Over Markets, the channel where we master the psychology behind smarter trading and stronger financial decisions. In today's episode, we're diving deep into one of the most powerful emotional traps in the markets, overcoming the fear of missing out, or FOMO. If you've ever watched a price explode without you, if you've ever jumped into a trade too late because everyone else seemed to be profiting, or if you've ever felt that urgent pressure to act right now before it's too late, then this episode is for you. Today, we're going to break this down into 5 powerful and interconnected parts. Part 1. Understanding what FOMO really is, where we uncover the true psychological roots behind that sudden urgency to act. Part 2. How FOMO destroys decision making, where we explore how chasing moves, overtrading, and emotional sizing quietly damage your performance. Part 3. The psychological root of FOMO, where we examine the deeper beliefs about scarcity, comparison, identity, and impatience that fuel this fear. Part 4. Practical strategies to break free from FOMO, where we introduce structured tools and systems that protect you from emotional trading. And finally, Part 5. Mastering patience and long-term thinking, where we shift from reacting to markets to operating with calm, disciplined confidence. Each part builds on the one before it, so I encourage you to stay with me all the way to the end, because understanding FOMO isn't just about avoiding bad trends, it's about transforming the way you think, act, and perform in the markets. Let's begin. Fear of missing out, commonly known as FOMO, is one of the most powerful and destructive emotional forces in decision-making, especially in financial markets. At its core, FOMO is not really about money. It is about fear. Fear of being left behind. Fear of missing an opportunity that could change everything. Fear that everyone else is moving forward while you are standing still. In trading and investing, FOMO usually appears when price begins to move quickly and aggressively. An asset starts rising sharply. Headlines become louder. Analysts begin making bold predictions. Social media fills with screenshots of profits and stories of life-changing trades. Suddenly, a quiet but persistent voice inside you begins to whisper, "What if this keeps going without me?" That voice does not care about your strategy, your risk management, or your long-term goals. It only cares about avoiding regret. This is what makes FOMO so powerful. It reframes the situation in your mind. Instead of evaluating the opportunity based on logic and probability, you begin evaluating it based on emotion. The decision shifts from "does this fit my plan?" to "can I afford to miss this?" That subtle shift changes everything. FOMO creates urgency where none is required. It compresses time psychologically. A trade that could have been calmly analyzed over hours or days suddenly feels like a now or never moment. Your body responds as if there is danger in waiting. Your heart rate increases. Your thinking narrows. Patience feels risky. Acting quickly feels safe. But the market itself has not changed in that moment. What has changed is your perception. The urgency exists in your mind, not in reality. Markets offer opportunities repeatedly over time, yet FOMO convinces you that this single move is unique, rare, and impossible to replicate. What makes FOMO especially dangerous is that it often disguises itself as opportunity. It feels like confidence. It feels like decisiveness. It can even feel like intuition. You might tell yourself that you are being bold, that you are finally taking action instead of hesitating, but in truth, you are reacting. You are responding to external noise rather than internal preparation. There is a major difference between conviction and compulsion. Conviction comes from research, experience, and alignment with a clear strategy. Compulsion comes from emotional discomfort, the discomfort of imagining others succeeding without you. FOMO thrives in that discomfort. Comparison plays a critical role in fueling this emotion. When you see others posting gains, your brain automatically compares your position to theirs. You rarely see the full picture. You do not see their past losses, their sleepless nights, the risks they took, or the trades that failed. You see the highlight reel. Your mind fills in the blanks with assumptions that exaggerate their success and minimize their struggle. This distorted perception creates the illusion that you are falling behind. Even if your portfolio is stable, even if you are following your plan, even if your approach is working, FOMO convinces you that stability is weakness and patience is stupidity. It makes disciplined investing feel like inaction. Another hidden danger of FOMO is that it disconnects you from your time frame. A long-term investor suddenly starts thinking like a short-term trader. A swing trader begins chasing intraday volatility. Your identity shifts in the heat of emotion. You abandon your edge and step into a game you were never prepared to play. The uncomfortable truth is that FOMO is often a signal that your plan is unclear or your confidence in it is fragile. When you deeply trust your process, the success of others does not threaten you. You understand that markets are not a race. They are a marathon with endless cycles of opportunity. But when your strategy lacks clarity, every market move feels personal. Every rally feels like exclusion. Every missed entry feels like failure. And that emotional pressure pushes you toward impulsive decisions that rarely end well. Understanding FOMO is the first step toward overcoming it, not by suppressing it or pretending it does not exist, but by recognizing it clearly. When you feel urgency rising, pause and ask, is this aligned with my plan, or am I trying to avoid regret? That simple question can restore rational thinking. FOMO is an emotional response rooted in fear, not logic. It is a natural human reaction, but it does not have to control your actions. The more aware you become of its patterns, urgency, comparison, distorted perception, the less power it holds over you. Until you learn to identify it clearly, FOMO will quietly steer your decisions without your awareness. But once you recognize it for what it is, you begin to reclaim control not just over your trades, but over your mindset. FOMO doesn't just influence decisions, it distorts them. The moment it enters your thinking, your perception of risk begins to shift. What once looked extended now looks unstoppable. What once seemed risky now feels urgent. You stop asking, is this a high-quality trade? And start asking, what if I miss it? That subtle shift is powerful enough to turn disciplined traders into emotional gamblers. When FOMO takes over, logic does not disappear. Completely, it gets overridden. You may still know your rules. You may even remember your risk parameters. But emotionally, they feel less important than the possibility of missing out. The fear of regret becomes stronger than the fear of loss. And that imbalance is dangerous. One of the most common effects of FOMO is chasing price. You enter trades late, after the majority of the move has already happened. The chart has already expanded. The early entries are long gone. At this stage, risk is objectively higher, reward potential is lower, and probabilities are weaker. Yet FOMO convinces you that momentum will continue indefinitely. It tells you that this time is different. Most of the time, it isn't. Chasing price often leads to poor entries at emotional extremes, buying near short-term tops or selling near short-term bottoms. When the inevitable pullback happens, it feels personal. You interpret normal market behavior as confirmation that you made a mistake. Stress increases. Decisions become reactive rather than strategic. FOMO also fuels overtrading. When you are afraid of missing opportunities, patience feels uncomfortable. Waiting feels like inaction. Instead of allowing high-probability setups to form, you begin seeing opportunity in every small movement. A minor breakout looks explosive. A small dip looks like a once-in-a-lifetime entry. Your standards quietly drop. Over time, this leads to exhaustion. You are constantly scanning, constantly reacting, constantly in positions. There is no rhythm, no selectivity, no space for objective evaluation. Losses start to feel random, even though they are often the result of low-quality decisions. The more you trade without an edge, the more chaotic trading appears. Another dangerous effect of FOMO is position sizing errors. Under emotional pressure, traders often increase their size beyond what their plan allows. The internal reasoning is simple. If this is going to run, I want to make it count. But larger size amplifies everything, both gains and losses. It magnifies stress. It makes every tick feel significant. With oversized positions, normal fluctuations become emotional triggers. A small pullback feels threatening. You exit too early out of fear, or you hold to long out of hope. Either way, you are no longer operating from a calm, structured mindset. You are reacting to discomfort. To overcome FOMO, you must first understand where it truly comes from. FOMO is not created by charts, price movements, or breaking news. Those are only triggers. The real source lies deeper in your beliefs, deep psychological beliefs about time, success, opportunity, and ultimately, self-worth. At its root, FOMO is built on the belief that opportunities are scarce. It whispers that if you do not act now, you may never get another chance. It tells you this move is special, rare, and irreplaceable. That belief feels urgent and emotionally convincing, but in reality, markets operate in cycles. Trends form, expand, exhaust, and reset. New opportunities emerge again and again over time. What markets do not offer is protection from reckless decisions made under emotional pressure. The scarcity belief distorts perception. Instead of seeing one trade among thousands, you see a once-in-a-lifetime moment. Instead of thinking long-term, you think in extremes, now or never, win or regret. This mindset compresses your patience and exaggerates the importance of a single outcome. FOMO is also closely tied to identity. Many traders unconsciously attach their self-worth to performance. Profits feel like proof of intelligence, discipline, or superiority. Losses feel like personal failure. In this mental framework, missing a profitable trade is not neutral, it feels like losing status. Watching others succeed can feel like evidence that you are behind, incapable, or inadequate. When self-worth becomes entangled with market results, objectivity disappears. You are no longer evaluating trades based on probabilities. You are evaluating them based on what they say about you. A rally without you feels like rejection. A breakout you did not catch feels like embarrassment. The market becomes a scoreboard for identity rather than a system of risk and reward. Another powerful root of FOMO is impatience with progress. Trading success compounds slowly. Skill develops gradually. Confidence is built over years, not weeks. But the human mind craves acceleration. When results feel slow, the temptation to speed things up becomes intense. FOMO offers that illusion of speed. It promises that one bold move could make up 4 months of patience. This fantasy is deeply seductive. The idea that one trade could change everything bypasses logic and speaks directly to desire. It offers relief from frustration and escape from comparison. But it is dangerous because it encourages oversized risk and impulsive decisions. Sustainable growth rarely comes from emotional shortcuts. Social influence intensifies FOMO even further. Humans are wired for belonging. We look to the group for cues about safety and correctness. When everyone appears to be buying, celebrating, and profiting, not participating feels uncomfortable. It feels like exclusion. In evolutionary terms, exclusion once meant danger. That instinct still lives in the brain. But markets are not social approval systems. They are competitive environments. By the time something feels obvious and widely accepted, much of the opportunity has often already been priced in. Herd behavior may feel safe emotionally, but it frequently increases financial risk. The crowd tends to act strongest near emotional extremes. FOMO also thrives in uncertainty. When you lack a clear plan, defined criteria, or structured rules, your mind searches for guidance. In the absence of internal clarity, you turn outward. You look to price spikes, social media commentary, influencers, or headlines to tell you what matters. This external dependence creates emotional vulnerability. Every new piece of information feels urgent. Every movement feels meaningful. Without a framework, you drift, and in that drift, FOMO grows stronger. Because when you do not trust your own process, the actions of others seem more credible than your own restraint. The key insight is this: FOMO is not really about missing trades. It is about missing reassurance. It is the discomfort of not knowing for certain. It is the anxiety of sitting still while others appear active. It is the tension of uncertainty without immediate validation. Once you understand this, something shifts. Instead of fighting FOMO as an enemy, you begin to see it as information. It signals insecurity in your beliefs about scarcity, identity, progress, or belonging. And when you address those beliefs, the emotional intensity begins to weaken. You stop trying to eliminate FOMO entirely. Instead, you learn to manage it by strengthening your plan, separating self-worth from outcomes, accepting uncertainty, and trusting long-term opportunity flow. When your beliefs become more stable, your reactions become more measured. FOMO loses its grip not because markets change, but because your internal framework does. And when your beliefs are aligned with reality, abundance over scarcity, process over ego, patience over urgency, you regain control over your decisions. But markets are not social approval systems. They are competitive environments. By the time something feels obvious and widely accepted, much of the opportunity has often already been priced in. Herd behavior may feel safe emotionally, but it frequently increases financial risk. The crowd tends to act strongest near emotional extremes. FOMO also thrives in uncertainty. When you lack a clear plan, defined criteria, or structured rules, your mind searches for guidance. In the absence of internal clarity, you turn outward. You look to price spikes, social media commentary, influencers, or headlines to tell you what matters. This external dependence creates emotional vulnerability. Every new piece of information feels urgent. Every movement feels meaningful. Without a framework, you drift, and in that drift, FOMO grows stronger. Because when you do not trust your own process, the actions of others seem more credible than your own restraint. The key insight is this: FOMO is not really about missing trades. It is about missing reassurance. It is the discomfort of not knowing for certain. It is the anxiety of sitting still while others appear active. It is the tension of uncertainty without immediate validation. Once you understand this, something shifts. Instead of fighting FOMO as an enemy, you begin to see it as information. It signals insecurity in your beliefs about scarcity, identity, progress, or belonging. And when you address those beliefs, the emotional intensity begins to weaken. You stop trying to eliminate FOMO entirely. Instead, you learn to manage it by strengthening your plan, separating self-worth from outcomes, accepting uncertainty, and trusting long-term opportunity flow. When your beliefs become more stable, your reactions become more measured. FOMO loses its grip not because markets change, but because your internal framework does. And when your beliefs are aligned with reality, abundance over scarcity, process over ego, patience over urgency, you regain control over your decisions. Overcoming FOMO does not require willpower alone. Willpower is unreliable, especially under stress. In the heat of a fast-moving market, emotions are stronger than intentions. What truly reduces FOMO is structure. Systems reduce emotion because they reduce decision-making in moments of pressure. When decisions are made in advance, stress has less influence. The first and most important strategy is having a clearly defined trading plan. A real plan is not vague. It does not say, buy strong markets or trade breakouts. It specifies exactly what conditions must be present before you enter a trade. It defines your time frame, your setup criteria, your entry trigger, your stop-loss placement, your profit target, and your maximum risk per trade. It also defines when you do not trade. When rules are written and specific, FOMO has less room to operate. Instead of asking, should I jump in? You ask, does this meet my criteria? That shift is powerful. It moves the focus from emotion to execution. If the trade does not fit your plan, the decision is already made. You do not debate with yourself in the middle of volatility. The second strategy is learning to accept missed trades as part of the process. This is uncomfortable but essential. No trader catches every move. Even the most experienced professionals miss opportunities regularly. The difference is that they do not interpret missed trades as failure. They see them as neutral events. When you accept that missing trades is inevitable, the emotional charge decreases. You stop chasing price after it has already expanded. You understand that protecting capital and maintaining discipline is more valuable than participating in every rally. Participation does not equal profitability. Discipline does. Another powerful tool is journaling. Many traders underestimate its impact. Writing down why you entered a trade, what conditions were present, and how you felt at the time creates self-awareness. Over time, patterns emerge. You begin to see the difference between planned trades and impulsive ones. FOMO trades often have specific emotional signatures: urgency, fear of regret, comparison to others, or frustration from a previous loss. When these feelings are documented, they become easier to recognize in real time. Awareness interrupts automatic behavior. You cannot change what you refuse to observe. Limiting exposure to noise is also essential in reducing FOMO. Constantly watching price ticks, scrolling through social media, and consuming endless financial news amplifies urgency. The more inputs you consume, the more reactive you become. Every headline feels significant. Every price spike feels meaningful. Reducing noise creates mental clarity. You do not need to monitor every movement to make effective decisions. In fact, overexposure often weakens discipline. Structured review times, predefined trading hours, and intentional breaks from screens help restore objectivity. Fewer inputs often lead to better outputs. Position sizing is another powerful emotional anchor. When your risk per trade is controlled and aligned with your overall strategy, emotional pressure decreases dramatically. Smaller, consistent position sizes make fluctuations manageable. They allow you to think clearly during pullbacks or consolidations. FOMO thrives when stakes feel too high. If you risk too much on a single trade, every tick feels dramatic. Fear and excitement intensify. Decision-making becomes reactive. But when risk is measured and sustainable, you remain calm. Stability in risk creates stability in mindset. Finally, you must redefine what success means. If success is defined as catching every big move, you will always feel behind. Markets are continuous. There will always be another opportunity you did not take. But if success is defined as executing your plan consistently and managing risk responsibly, the game changes. When process becomes the goal, outcomes lose some of their emotional grip. A missed trade that did not meet your criteria becomes a victory for discipline. A small, controlled loss becomes proof that your risk management is working. Progress is measured in consistency, not excitement. Breaking free from FOMO is not about eliminating emotion entirely. Emotions are part of being human. The goal is not to suppress them, but to prevent them from dictating behavior. Structure creates boundaries. Rules create clarity. Awareness creates choice. When you build systems that guide your actions, you no longer rely on momentary feelings to make decisions. You act intentionally rather than impulsively. Over time, that intentional approach compounds just like capital. FOMO loses power when preparation replaces impulse, when patience replaces urgency, and when process replaces ego. The market will always move. The question is whether you move with intention or reaction. The final step in overcoming FOMO is adopting a long-term perspective. Markets reward those who think in probabilities, not isolated moments. A single missed trade only feels significant when you zoom in too closely. When you zoom out, you see that one trade means very little in the context of hundreds of future opportunities. FOMO thrives on short-term thinking. It tells you this move is special, that this breakout will never come again. A long-term mindset breaks that illusion. Markets move in cycles. Trends form, extend, retrace, and repeat. Opportunity is constant. Urgency is not. Patience is often misunderstood. It is not passivity or hesitation. It is active discipline, the decision not to act when your criteria are not met, even when emotion pushes you to move. It is the strength to wait while others rush in. That restraint is a skill developed through practice and self-awareness. When you stop measuring progress by individual trades, FOMO weakens. Success is no longer about catching every move. It becomes about executing your plan consistently. The question shifts from "what if I miss this?" to "does this align with my edge?" That shift restores control. You stop reacting to the market's speed and start operating from structure. Long-term thinkers understand that preserving capital and mental clarity matters more than short-term excitement. Emotional trades may feel thrilling, but they often lead to stress and inconsistency. Calm, disciplined execution may feel less dramatic, but it compounds steadily over time. There will always be another setup, another breakout, another trend. But your capital and confidence are limited. Protecting them must come first. Overcoming FOMO means trusting yourself more than the noise around you. It means becoming comfortable with waiting and accepting uncertainty. Sometimes the most profitable action is no action at all. When you reach that point, trading becomes calmer and more sustainable. You stop chasing movements and start selecting opportunity, because the greatest edge in the market is not speed, it is patience. If this resonated with you, stay committed to your process, refine your plan, journal your trades, choose discipline over impulse one decision at a time.